Yeah, I think the big lesson we learned, and the big lesson all equity investors should learn, is that interest rates really, really matter. 2019 was a year of very weak economic growth. It was a year of large earnings downgrades across the market. It was a year of a lot of political uncertainty, and then we also had the trade war layered on top of that. Yet the moves that the Federal Reserve did earlier in the year to lower the risk-free rate ultimately supported markets throughout the year. And I think the best way to think about this is to think about it in terms of the equity risk premium. So what we do at Munro is we divide the PE multiple by the risk-free rate, and that spent most of the year at roughly 400 basis points. So you got a 400 basis points carry for investing in equities all year, and that's very high versus history. And no matter how bad earnings got, or no matter how bad the market got, ultimately the 10-year bond fell further, and that ultimately supported markets throughout the year. Yeah, so as we look at 2020, and I think this is also a little bit of a lesson from 2019, is it's probably going to be okay. If you go back over history, the last 25 years, global OECD GDP has been positive every year except for one, and that's the financial crisis. And so I think the first and foremost point is that it's probably going to be okay. The second thing we'd say more specifically is if we look at PMIs around the world, as I said, it was a very weak year for growth last year, and a lot of those PMIs are probably bottoming now. And so ultimately, if you look at all PMI charts over a long period of time, you can see big recessions and you can see mid-cycle slowdowns. And I think what we're looking at here is a mid-cycle slowdown. And the reason why we think they're bottoming and the reason why we think they will recover is ultimately we have a trade deal. Secondly, we have those low rates we just spoke about, and they will be flowing their way through economy. And thirdly, you just start to cycle a lot of that bad data from last year. So ultimately, you have a year of reasonably good economic growth, or some reasonable economic growth. And on top of that, you have a Federal Reserve, that key interest rate environment that generally has a stated aim of being on hold. And so at this point in time, at least it looks like a fairly benign outlook for equity markets at the start of the year. Yeah, so assuming we're right about the benign outlook, and at least with a low rate environment, this does actually support what we do. Our job at Munro Partners is to find companies that can grow at a faster and more sustainable basis than the peer group, and this is a good environment to do that because those companies become very attractive in a low rate environment that we see going forward. And so the first area of interest that we'd want to flag as a good area of growth for us in 2020 would be high performance computing. And here we're effectively talking about semiconductors or the semiconductor industry. And what we see here is if you look at the intersection of cloud computing and the intersection of the Internet of Things, you're essentially going to need an awful lot of semiconductors in the world because ultimately we're going to move, as we move into 5G and as cloud computing becomes more prevalent, we're going to end up with more and more devices connected to the internet and hence more and more data that can be produced. And so we talk about this as the sandstorm that's coming in the cloud. The other thing that's great about this area is it's also very much a play on the technology war that's essentially occurring between not just big internet companies around the world, but also between the two big countries of the world being China and the US. And so here we really are trying to take advantage of the dollars that are clearly going to fly into this area of technology. And so our weapons manufacturers in this war are mainly semiconductor companies. The first area that we focus on is equipment. And here we're talking about lithography equipment. And there's one high-end player that stands out amongst all the rest, and that's ASML. The second area you can talk about is Foundry. So this is Semiconductor Foundry. These are the people who build the semiconductors. And again, there's another high-end player that stands out amongst all the rest, and that's TSMC. The third area is really this artificial intelligence. So this is where the war is really going to happen, is how do you actually train these computers to interpret all this data and do everything? And again, there's a standout player here, and that's NVIDIA. And the last area is really around the Internet of Things. Here, there's a number of companies to choose from, i.e. the companies that produce all the cheap and smaller semiconductors that we're going to use here. And the one we like here is Texas Instruments. But ultimately, we really like this area because it's a play on the dollars that are going to be spent on this technology war. And it also has that cyclical characteristic that we're looking for as we move into 2020. Yeah, so the second big area we wanted to talk about is this big area for us to invest next year is in climate change. This is an area that we looked at a long time ago, back in the early 2000s. And we think it's now going to come to the forefront again. Ultimately, we feel we've reached the tipping point in climate change. And there's a really good reason for this. The reason why is because we're no longer relying on governments to help us reduce carbon. Corporates are doing it anyway. And the corporates are doing it because they believe their stakeholders care about it. And when we say their stakeholders, we mean their employees and their customers. And so what we see when we look around the world is every corporate we look at is effectively committing to a zero carbon target in 2030 or 2050. And here we're talking about companies like Starbucks, like Walmart, like Vodafone. And on top of that, we also have whole countries committing to zero carbon targets in law, including the UK, France, and states of the US, including California. and New York. And so what that means is we effectively have $1 trillion that needs to be spent, in fact, more than $1 trillion to decarbonise the planet. And this is without doubt going to be one of the big investment trends of our lifetime, because this tipping point has been reached. And whether you believe in climate change or not, I'm here to tell you that this is going to happen no matter what. And so from our point of view, we want to follow the money here, and we have a number of investments. The key areas for us to focus on are clearly renewable energy is first and foremost. There's no point having an electric car if it's powered by a coal power station, so renewable energy is first. And here we've identified a number of companies in the top bar part of this chart. The second area where is clearly transportation. Transportation is clearly one of the key emitters in the world. The obvious investment is Tesla, where we're not invested today, but we are invested in Infineon, which is a key semiconductor player within that area. And the last area is a little bit more subtle, mainly around urban efficient buildings and paper and packaging, and I think the move to single-use plastics, etc. And so I think what we're saying here is we see a lot of dollars moving into this area now. They're moving in there regardless of government subsidies, and we see a lot of potential winners. We've picked out 4 today, but I suspect we're going to be picking out more as the year goes on.